baby, we're diving into my stocks to buy a 2024 watch list, as I am now going to be able to finally start reutilizing my tax-free savings account after liquidating all of my money in that account to do a real estate purchase this year. I already have $20,000 set aside to put into this account where I'm going to be divvying it between growth and Canadian dividend stocks. We're going to talk about these two different sectors I'm going to be adding to this account to try and outperform the market. If that is a conversation you'd appreciate, as always, hit that like button. We're going to be going over all my favorite growth stocks from Tesla, Nvidia, Google. We'll even talk about Berkshire Hathaway to the Canadian banks, some of the REITs, the telecom giants. But first and foremost, let's just say, hey, a lot of people are super concerned that the market is going to pull back in January, that we need some kind of a pullback. And if there's one thing I've learned, it's really hard to stop a bull market. Eventually, it's going to pull back. How much? Nobody knows, but earnings will be the deciding factor. If we are overbought and earnings come in at expected values, we could still see a pullback. If we miss earnings, we're definitely going to see a pullback. But the fact of the matter is, as much as I believe tech is kind of overvalued here, that doesn't mean it's going to pull back. That's why you just consistently buy. And though I'm looking at adding individual stocks to my portfolio, I will still always be buying the S&P 500. Now, taking a look over this week, again, everything is green in the US markets. Everything is green across the broader Canadian markets. And it's great. I love it. No one's complaining here seeing their accounts go up. We're just not getting the same discounted buying opportunities we were, but we took advantage of it, right? We bought a lot of the S&P at the bottoms of October. We were buying a lot of these Canadian stocks on discounts, and I still think a lot of them are discounted. So let's talk about it. First and foremost, the growth side. Now, as many of you know, my fiance, she owns a lot of tech companies already, and I'm not going to be over leveraging into them. I'm looking at the other half of the tech companies we don't already own. So we own Apple and Microsoft. We own some, huge, actually Meta's the largest position between our accounts. But what I'm really looking to buy here is Google, Tesla. I've been analyzing Nvidia. I've even been looking at Berkshire Hathaway because we do not own any material or major amounts of these four stocks. So taking a look at, first and foremost, I want to do some comparables because I think Berkshire Hathaway is actually right now a cheap way of getting exposure to Apple shares. I am kind of shocked at the multiples that Berkshire trades at. And I'm not really sure why. I got to do some more math. Now we're looking at A shares. No one's buying A shares. Most of us will be buying B shares. But at a 10 PE and a $779 billion market cap, it is almost a steal of a deal if you're comparing it to a company like Tesla. Now, I've always said that Tesla at the right price, I would start cost averaging in. I thought that would be under $200 this year, but we only dipped down to under 200 literally for a day, and then it went right back over. This company is insanely expensive, and as much as I love Tesla, you have to recognize that as somebody that wants to retire early, I can't do that with companies where I know I have to wait for 10 years for these business models to catch up. I think Tesla has huge potential beyond the next decade, but within the next decade, for somebody that wants to fast track retirement, I just don't think Tesla's that company at anything at the current valuations. And I'm not trying to say Tesla's a bad company. They've got good growth ahead of them, but they're only making money off their cars, their power walls, some of their obviously charging networks, their solar panels, just a few things. And they're growing, but they've been slowing down so damn much this year, and I can't be hyped on robotics and AI and self-driving when it doesn't materially add any revenue to the balance sheet, right? So you got to be really careful depending on what your plans are buying a company like this. And let me just show you the almost insane comparables. Tesla's growth rate has completely declined in this higher interest rate environment. They've been cutting car costs. They've been losing margins. They've been generating about $23 billion a quarter, $95 billion on an annual run rate here. But if you compare that to a company like Berkshire, Berkshire's generating $349 billion on an annual run rate, almost 4 times what Tesla's making, $93 billion a quarter, and somehow I've been seeing a growth rate this year, and I don't know if it's a one-off or what's causing it, but they're generating a 20% growth rate in revenue this year. And I'm really curious to how and what is driving this, but you have to recognize when you look at today the true value of what you're buying for somebody that wants to retire within 10 years. Berkshire is clearly the steal. It is not Tesla. Everything about Tesla has just been stagnating. And again, you have to recognize there's a lot of hype built into this company already. And I really think after 2030 is the time that Tesla really propels itself. I'm just not somebody that I'm constantly playing this devil's advocate for Tesla, trying to convince myself to buy it. But I feel like I'd be doing a fool's errand buying it at anything over $200, the current value. It's just a little bit nutty. Now, speaking of nutty values, I mean, you take a look at a company like Nvidia here, and Nvidia was a company I thought was a bubble. Everybody thought it was a bubble. Hell, even Kathy Wood sold it right at the bottoms here. But what we have to recognize is Nvidia is basically a train unlike any business that has ever existed in the S&P top 10. It is the greatest tech company currently of all time because of what it is achieving. And at a 65 times multiple, it's cheaper than Tesla, and it will be cheaper than Tesla if it continues this growth. But as somebody that's run a business, anyone that's telling you that things are streamlined, cut dry, and simple to understand, that's not how business operates. You can't just trust a balance sheet, because right now Nvidia's got the greatest balance sheet of any company that exists. Their gross margins are 74%. For every $100 of product they sell, they keep 74 bucks. There's no company in the S&P that can say that. None of them. I don't think there's ever been a company in the top 10 that's been able to say that. And their net income is at $9.2 billion, and it's grown 1,200% year over year and 50% quarter over quarter. They only have to do this for the next 2 or 3 quarters, and they will be making as much money as Apple. But everybody understands that growth rate is largely going to be unsustainable. We're going to reach parity with this AI cloud computing growth rate eventually, or we're going to see competition, because like drug dealers, you start making too much money, people start to take notice, and they're like, I want a piece of that pie. So this is going to be unsustainable. But if you're buying it today at this high multiple, they only need to make the next 2 or 3 quarters of this kind of growth, and you've justified the 65 times multiple, because you're cutting it in half almost every quarterly earnings, right? So I mean, you're really just kind of playing a catch-up game. Like, if I buy it today, can I justify it if it can last for another year? And then you're good. You're in the clear. Like, you've really justified the value. You probably saw some good gains. Who knows, though? Speculative. I don't have the cojones to buy it, so I'm glad I can own it through the S&P 500, and we'll just see where the chips fall. But anyone buying this is taking a huge speculative risk, at least into the short term, right? So the one stock I know is a true and tried buy, unless something happens like Apple decides to cut them off from being the primary default browser on Apple when you get a phone. I think they're going to be fine. But when you're talking about a company trading at a 26 times multiple, which for Google is actually fair value in my opinion, at a $1.77 trillion market cap, which is almost half as much as Apple's. But when you compare Google to Apple, Google's generating $19.6 billion in net income, and Apple is generating about what, $22 billion. So they're not actually that far off from generating the same net income as Apple. But Apple's balance sheet is not as nice. They have $352 billion in assets and $209 billion in liabilities. You compare that to Google's balance sheet, and it's almost damn laughable. I mean, you take a look at this, right? Google's got $365 billion more assets than Apple and only $109 billion in total liabilities. Technically, I really think that Google should be trading for about another $500 billion to $1 trillion more in its market cap to be trading more in favor with Apple. But that's just my personal opinion. So it's a stock that I think is worth buying on an individual basis, considering I do make most of my money off YouTube these days. Now, on the Canadian side of the border, I actually just sold VDY because it's been a Parker Place position without me having to deal too much with trading fees until next year rolled over, so I could start topping up my TFSA. So that's what I did. I sold Vanguard, the FTSE Canadian High Dividend Yield ETF, which is my favorite. I'm still going to be buying this at some point, but I want to take this money and start distributing it the way I had it distributed before. And what I'm going to do first and foremost with some of this money is I'm going to make my own Canadian equal weight bank ETF. The banks have largely outperformed the broader Canadian markets. They have not kept up with the U.S. markets, but if somebody that wants to generate income, I think this is a very good way and a very easy way to outperform basically the broader Canadian markets, because unlike the U.S. where regional banks go bankrupt, Canada has a highly regulated kind of monopolistic banking system, right, where we've had the same 5 damn banks for the last 100 years. And the problem is these equal weight bank ETFs just charge way too much. I mean, I'm not going to pay 0.25% to own 5 companies, but that's actually taking away a good percentage of this dividend yield as well. And I'm trying to get an average of about a 5% yield. If we look at the long term since 2009, the rate of return has been astounding, about $40,000. So I mean, just over 25 years or so, you've locked in from $10,000 to $40,000. That is an incredible amount of growth for total return, right? But you just take a look. It's all your favorite banks. Why? They're like Pokemon cards. Just collect them all. You got Canadian Imperial, Bank of Montreal, Royal Bank, National Bank, TD, and Bank of Nova Scotia. I could just as easily buy all 5 of these and not pay somebody a fee to own them. And then I can just set them up on a drip and let them reinvest for the time being, because what people are unaware of, and I think BNS just got rid of it, but some of these banks do offer discounted reinvestment shares. So if you reinvest the dividends, they'll actually give you a discount on the shares. Though I don't think BNS is doing that anymore, but they used to be. But still, it's great. I love the Canadian banks. Always will, ride or die kind of companies. Now, on the other side of the Canadian system, as mentioned, I think the most discounted stocks, and these are going to be my recovery plays are things that are going to take advantage of the interest rate cut cycle. And we're probably at least a good 2 quarters out from seeing any material impact, because it'll take another quarter for us to see the impact after the first interest rate cuts on companies that are infrastructure and heavily debted, that are stuck paying these interest payments. But I love TELUS because it's one of the only telecom giants that consistently hits record revenues every single quarter. It is blowing record number of customer acquisitions out of, like, just going bananas on its balance sheet. Yet the problem is they're doing a lot of write downs for upgrading infrastructure. They're doing a lot of, obviously, like, we're building out LTE, we're building out fiber optics, and they're writing a lot of that down, but they're also paying a lot in debt. So it's really been eating them big time here. I mean, they're still down 30%. They've jumped back to prices we haven't really seen since probably about 2017. Heck, you could probably even go back to 2015. And for a company where you can get your total return, really healthy full rate of return just off the dividend yield, I'm very much looking forward to adding this at the current discounts. Now, I've also been looking at a lot of the Canadian REITs. We own RioCan still. I really like Canadian apartment properties, though a lot of these REITs have jumped up pretty dramatically, about 30% from the lows. They're still trading down a lot from some of the recent highs. And I still think these are also going to see a huge benefit from the recovery, because they're getting like a really good setup. Not only are they seeing, because this is Canada's largest apartment property REIT, it's just purely rental properties, nothing office based, just basically residential. They are seeing this massive influx of being able to raise rents for the next 2 or 3 years. Every time they get a new tenant, it's going to be a new rental rate, because the current rental rates they're offering are very cheap, but that's based off old rental rates, because people that haven't moved out have been paying a lot less. And as soon as they get to recycle them, because the government only allows them to raise the rent so much each year, they're better off getting newer tenants, because then they can get market average rental rates, which are insane in Ontario. Especially if you live in Canada, you know how much rent has gone up, and this company's going to see the benefit of that for the foreseeable future. And then once interest rates come around the corner, they're also going to see the benefit of the interest rate cut cycle. So they have these two tailwinds that I think are going to make them a huge recovery play, and they have a great balance sheet. They're in an incredible position. They're probably one of the most sustainable balance sheets, with $17 billion in assets and only $7.7 billion in liabilities. They have about $10 billion in underlying assets, and their book value, I mean, you take a look, their market cap's $8.2 billion. So you're getting almost a $2 billion discount on the underlying asset value against their NAV price, right? I don't know if I'm going to buy it, though. I'm really much more fixated on the banks, the telecom giants, but I do see some potential for outsized returns to outpace the broader Canadian markets. But most of my fixation is going to be on things like Google, the S&P 500. I'm even beginning to think Berkshire here is probably a good way to discount buy your way into Apple, because I just don't get how you could be trading at a PE of like 10 and own Apple as the largest position in your portfolio. There's a lot of cool arbitrage ways to play some of these kind of, I think Berkshire is like an ETF, but I'll pass that question off to you. I'd love to know what you think about my stocks to buy watch list here coming into 2024.